Welcome back, econ students. We are in the tail end of chapter 10 and 11, and we're going to work on a project called the Bank of Clem. So if you want to look at page 290 in the textbook, that would be a place to get some of our ideas here. Page 290. But we are going to run through as if Mr. Clem wants to start up a bank. How does that work? And some transactions that happen at the bank level. So first thing we're going to do is we're going to form the Bank of Clem. And Mr. Clem would like to start up a bank. Here are the following steps that need to be taken. If I want to be a bank, I need to go get either a charter or a license to operate. I can't just open up a shed on my backyard and say, hey, I'm a bank now. So I have to go to either the state level of government or I got to go to the federal level of government to make that happen. They will then approve my charter or my license, and I can get myself up and going. Most of your banks are going to be formed as corporations. So what we're going to need to do is sell shares of stock. It's almost like I'm saying, here's a piece of paper that has a certain number of shares, and you're going to give me money per share, and that's how I'm going to get my business up and going. It's really not all that different from, Clem starting up a lawn mowing business, right? If I don't have the cash out of my savings or, get a loan from a bank, I could issue shares of stock and form as a corporation. We talked about way back in the beginning of economics. Well, same thing here. I'm going to form a bank and I'm going to treat it like a corporation, sell shares of stock to get it up and going. So before I actually go in, I got to do a little bit of planning, kind of like a business plan with a regular business. And I need to figure out how much money I need to get my bank up and rolling, right? You don't want to get just the absolute bare minimum because you're going to have a bunch of stuff that you're going to have to deal with. So that's what we're going to look at here in forming the Bank of Clem. First off, once I've got my charter ready to go from either the state or the federal level of government, I've done my math and said, I think I need this much money to get myself up and operating. I would work with an investment bank, right? A Deutsche Bank or a Goldman Sachs, and they would actually create the pieces of paper and go to the stock exchange in what's called an initial public offering or an IPO. Maybe you've heard of an IPO. And this is who is actually going to go trade those pieces of paper to investors and then get the cash for me. There's some fees involved, but again, that's above our pay grade. We don't care about that. So Clem goes to the state of Minnesota, says, I'd like to start up a bank. They say, fill out this paperwork. I fill it out. I tell them how many shares of stock I think I want to issue and the price I want to charge. They kind of give me the thumbs up. I call up Goldman Sachs and say, hey, this is Brian Clemon, starting up the Bank of Clem, approved through the state of Minnesota. I need you to go sell these shares of stock for me. Now, if there are not investors willing to buy those shares, Bank of Clem doesn't happen. But for argument's sake, let's say it does. So let's take a look at the balance sheet of a bank. Now, this is probably not all that different from what you've seen in either personal finance or accounting, that assets are all the things that a company would own. Well, this time it's a bank that's owning those assets, right? Liabilities are who they would owe money to, and then either owner's equity or stockholders' equity, that's going to be the value of the company's stock or the people who own the business, right? Now, I may be running the Bank of Clem, but I may not be owning the Bank of Clem. You guys as individual investors may be the ones who buy these shares of stock in a business you think is going to do well and grow over time. So let's look at some actual assets. What would be some things that a bank would own? Well, the first obvious one would be cash. Buildings and equipment would be another one. We're going to talk about reserves in a little bit. The Fed Reserve is going to make Clem keep a portion of its deposits with them. Part of that is for the check clearing process. Part of that is for ease of use and for the ability to actually be the bank for other banks. And we'll cover the Fed Reserve in Chapter 16. This may be counterintuitive, but if I'm going to borrow out money to other people or a loan, that's money they owe me. So if you're an accounting type person, that's like an accounts receivable, right? That's money that is owed to me in the form of a loan. And I could also go buy securities like treasury bonds, treasury bills, so on and so forth. Okay. My main liability is going to be the checkbook balances or the demand deposit accounts of my customers, right? Somebody comes into my bank, puts money in a savings account or a checking account, I owe them that money, right? So from my point of view, Bank of Clem, that's the liability. And then your equity account would be the value of capital stock. So if we add up the value of the checkbooks and the value of the capital stock has got to equal the value of all of these assets, right? Total assets equal total liability plus stockholders' equity. So let's go ahead and get Bank of Clem up and rolling. In theory, you can work your way through this. I am going to be sending you a Google Doc with either a T account looking grid to track your transactions. Again, it's got your assets on this side, cash, reserves, loans, securities, and building, or I got checkable deposits and capital stock. It's one way to do it, not good or bad, it's just one way to do it. Here is more of a grid kind of look where I have my assets on the left-hand side and I got my liabilities and stockholders' equity on the right-hand side. I don't care which way you go about it, but you need to go about it one of these two ways. And for the first transaction or two, I'll do both sides with you. And after that, I'll probably just stick with the grid because that is easy to see on one piece of paper. Do one of the two. Don't do both. Right? Now, if you're kind of a dork like me, maybe you would do both, but I only need you to do one of the two. Okay? So transaction number one. Like I said before, I've decided that I need $1 million to get my bank up and rolling. So I'm going to create 1 million shares of stock, and I'm going to charge $1 per share. So 1 million shares times $1 each means I'm going to get $1 million. The investment bank is going to go sell those shares of stock. So two accounts are going to change. Okay? Goldman Sachs or whoever I deal with is going to give me a pile of money, and somebody is going to have ownership claim in my business. So capital stock is going to go up 1 million. So let's go look at the T account way of doing it. Transaction one, I'm going to add $1 million there. And share of stock, $1 million there. Right. First transaction, 1 million, 1 million. Okay. 1 million on the left, 1 million on the right, transaction still in balance. If I did the T account way, again, I would have $1 million starting balance of my checkbook. And then I scroll down a little bit to capital stock, and I have $1 million worth of capital stock, right? Stuff on the left side, assets equals stuff on the right side. Whether you like this T account way or you like this grid way, right? So transaction one complete in the books. Two accounts are going to change, and the accounting equation or the balance sheet is still going to balance. So go to the grid, update either the grid or the T account, either's fine with me. Transaction number two. Okay, so Goldman Sachs sends an armored truck to Clem with just a big old box full of money, right? And they dump it off and they say, here you go. And I go, oh crap, I can't just leave it sit out here. So I'm going to have to go get a place to operate. So Clem chooses to purchase a building along with some equipment to run my bank and a vault and stuff like that. So I'm going to spend $500,000 to buy myself a building to house my bank out of. So when I look at my two accounts, I'm going to go ahead and have to spend some cash to go ahead and buy this building and equipment. So again, two accounts are going to change. Looking at it from this view here, the M is the math, so I'm going to subtract $500,000 there. And now I'm going to calculate my new balance. So I still got $500,000 sitting left in my pile of cash, if you will. But now at least it's inside a building in a vault, right? So that's half of the transaction. Well, where's the other half? Well, the company owns this property, so it's going to increase $500,000. So again, I take my prior balance plus my transaction, and let's put some money on that. So again, here at the end of transaction, oops, take the bold off, end of transaction number 2, right? I still have $500,000 in a big old stack of cash, but now I got a building to put it in, right? $1 million over here on the left side, still $1 million over here on the right side. Right? Equation is still in balance. I can look at it from the T account way and say I'm going to subtract 500,000, new balance. Okay, 500,000. Keep color scheme simple. That one's yellow. Now I scroll down here and find the place where I got a building. Now I got a $500,000 building, right? Building and equipment goes up 500. Checking account went down 500, or cash went down 500. So I still got a balance. $1 million on the left side, $1 million on the right side. Let's go ahead and do one more transaction, and then we'll take a break because these could get pretty long. I don't want you to sit here and watch this for 30 straight minutes. So transaction number 3. I'm ready to open my doors, right? And I'm going to open my doors to my customers, and customers are going to come in and they're going to drop down. Again, I'm just making these numbers up, but they're going to drop down $120,000 worth of money. Now, whether that's in a savings account or a checking account or a money market account, whatever, we're just going to make it simple and put them all in checkbook balances, or what we call checkable deposits, right? So money is coming into my bank, $120,000, but who has claim to that money? Well, my customers do. So checkable deposits is also going to go up $120,000. So since we're already here, we're going to add $120,000 there. So my new balance is, it was 500, add 120, and we'll color that one up green. Well, now checkable deposits over here is 120. And again, just color that up green so we can kind of, see our transactions. If I look at my grid way of doing it, again, the M means math of the transaction. So I'm adding 120,000. Color that up green. And over here, checkable deposits. Prior balance plus this transaction, and I'm going to color that one up green. All right. So the Bank of Clem sold its initial shares of stock. It got some startup cash or capital to operate. We then went ahead and bought a building to put stuff in because we don't want to just leave it sit out on the street corner. And then we opened our doors and we accepted our first deposit. So here are our first 3 transactions for the Bank of Clem. We got $1.2 million over here on the asset side, and we have $1.2 million or 1.12, $1,120,000 over here on the right side. I keep saying accounting equation because it's kind of like accounting, but my balance sheet balances. The stuff on the left adds up to the same stuff on the right. All right, we'll hit pause and then we'll pick up with transactions after this.